Do mortgage lenders let you borrow money out of the kindness of their own heart? Definitely not. Then why? Interest. Interest is paid as a percentage of how much is owed. Interest rates are expressed as annual rates of interest. So, if you take your loan amount or loan balance and multiply it by the annual rate of interest, you will have calculated the dollar amount of annual interest owed to your lender. But we don't pay mortgage payments annually, we pay monthly. The next step would be to divide by 12 to see how much is owed in interest for the month. The formula to calculate interest is simple. However, the formula to calculate your full monthly mortgage payment is complex. The easiest way to solve would be to search for Mortgage Payment Calculator and enter the loan amount, interest rate, and loan term. This will give you your full monthly mortgage payment of both principal and interest. As mentioned, a mortgage payment is comprised of two parts: the principal, which is how much you are borrowing and paying back, and the interest, which is the cost the lender charges to borrow the money. We just calculated the interest owed using the formula loan amount times annual rate of interest divided by 12. We must always pay the lender what is owed to them in interest first. Then, the remaining portion of the mortgage payment can be applied to the principal balance. As you can see on this example, the original loan amount is $250,000. Once we pay the interest owed, the remaining portion of the monthly mortgage payment will go to the principal balance. The principal for payment 1 is subtracted from the original loan balance, which gives us our new principal balance for payment number 2. We will repeat these calculations for each loan payment. So for a 30-year mortgage, this is completed 360 times. Amortization is the term used to describe the process of paying off debt in regular installments of principal and interest. If a person chooses a mortgage with an interest-only option, they will only pay, as the name suggests, interest only. This means there is nothing left of the mortgage payment to apply to the principal balance, and the principal balance will remain the same for the interest-only time frame, unless the borrower chooses to pay an extra amount above their interest-only payment amount and apply it to the principal. When a mortgage loan is set up so the mortgage payment is less than the full interest owed to the lender, the mortgage loan has a negative amortization feature. The unpaid interest that is owed to the lender is then added to the principal balance due, causing the balance to increase rather than decrease. I hope this information has been helpful. If so, please like and subscribe.